Welcome to Markets Narrative with Xlence, where we try to decode the markets behind the madness. Today, we have with us Andreas Haralambous, the market research analyst, and myself, Chris Karalis, the traders analyst.
Good to be here. Welcome, guys, to the first episode of our series. And today we're going to be discussing about the Federal Reserve upcoming interest rate decision.
And let's understand a little bit how the Fed works. The Fed in the US is actually the central bank, right? So who runs it? We have the chairman, Jerome Powell, right? We have the board of governors, and we have 7 governors. And we have the Federal Open Committee, which consists of the 7 governors, which is included the chairman, right? We have the Fed chair of New York, and 4 rotating bank presidents, right? So what is their main mandate?
So the main mandate of the Federal Reserve, an independent institution of the United States, if you would like, is to keep price pressures at a specific level that's going to be beneficial for the US economy. And that specific target level is widely agreed upon to be the 2% level. And this is what the central bank is actually striving for when they need, or when they actually look upon inflationary pressures. So this is one of the 2 mandates. The other mandate is to make sure that the employment market remains robust and resilient and good enough for people.
And the Fed meets every 6 weeks, or in total within a year about 8 times.
Yes,
correct. And it's something really highly anticipated from all investors, since it actually impacts the US stock market, the currencies, even gold as well.
Pretty much everything. So it's a highly anticipated event that most, if not all, traders are paying close attention to, as you just mentioned, because it has grave influences on not only stock markets and FX pairs in the FX market and all that kind of stuff. It has ricocheted kind of effects on bond markets as well and commodities. So again, when the Federal Reserve convenes and delivers interest rate decisions, the markets do pay close attention to these kind of releases.
And talking about the upcoming announcement, the 0.25 is already priced in the market.
Already baked.
All right.
Yes.
So what can we know about it?
So in regards to the upcoming Federal Reserve's interest rate decision, we see the markets aggressively pricing in a 25 basis point rate cut probability. So if I'm not mistaken, the last time I checked, it was somewhere around the 97% level. So again, the markets are extremely confident that the Federal Reserve is going to slash rates by 25 basis points, and the remaining 2 to 5% is actually looking past that, and they actually expect a larger 50 basis point rate cut by the Federal Reserve. Highly unlikely, but the fact that the market has already baked in the 25 basis point cut and they actually look forward for a larger cut, mainly due to the fact that we have seen the employment market showcasing cracks, it says a lot about not only the money markets, but the markets in general.
So we've seen cracks in the employment, all right? We can discuss this a little bit further, all right? But we also have seen Donald Trump trying to intervene to the independence of the Fed as well.
Yeah, we have seen some speculation, not only speculation, but we have seen the Federal Reserve being under siege or under pressure. More specifically, the head of the Federal Reserve, Powell, has come under fire from Trump, in a sense, saying all the time that he's late to the game. So, we have seen also Lisa Cook, another governor, prominent governor of the Federal Reserve, coming under fire and being actually fired by the Trump administration, not only until a federal court deemed the action from the administration as illegal. So in a sense, she remains at the board of governors of the Federal Reserve. So yes, we continue to see attacks, in a sense, from the Trump administration and the Trump himself towards the institution, in a sense, shaking up the markets and posing a threat for the so-called independence of this kind of institution.
And now the Fed is actually looking at the inflation and the jobs market as well.
Okay.
Now, the core inflation, when we say core inflation, this excludes the food and energy as well because it's highly volatile.
Both of them volatile.
Yes. So, but it currently sits at 3.1%. So it's much higher, at least higher than the target the Fed has, which is 2%, right?
Yes, the wide agreed upon target for the central bank is the 2% level. Again, it's a measurement, a rough estimate of where they do believe inflationary pressures should be, quote unquote, should be, in order for the economy, in order to allow the economy to grow, not at an extremely rate, but with a modest pace in a sense that's going to bring benefits to US consumers. So the fact that inflationary pressures have came down from the 10%, if I'm not mistaken, peak of 2022 down to 3.1% level, it's a big step towards the right direction, but the target has not yet been met, which may be an issue for the Federal Reserve, but for the time being, we do not only see the Federal Reserve, we do also see markets being extremely cautious, not extremely cautious, but being also extremely concerned about the health of the labor market rather than the possibilities of a possible reacceleration of inflationary pressures. So yeah, it is important in general to keep an eye on inflationary pressures, but at this specific point in time, markets tend to lean a lot more on what's going on with the labor market rather than inflation.
Well, talking about the market, we see that the stock market is actually flirting with all-time highs.
Time and time again, yes. We have seen many times this year both the S&P and the Nasdaq breaking into record highs week after week, which again signals exuberance, to say the least. Yeah.
Yes. So I think it might not be a fear for a recession in the US, all right? But at the same time, when the interest rate comes out, at the same moment, we're going to have the economic projection, also known as the forward guidance, right? And the FOMC statement.
Okay.
All right. So what can we expect about the forward guidance, which is a 2-year projection, correct?
So yeah, besides the fact that we have already seen markets pricing in the possibility for the 25 basis points, and not only that, but also pricing in 2 additional rate cuts by the end of the year, so 3 in total for a cumulative sum of 75 basis points. Markets are not primarily going to be surprised by the decision, if and only if it's only 25 basis points. Hence, the attention of the market is going to shift towards inflation expectations from the central bank, the economic projections in general in regards to GDP, consumption, all that kind of stuff, but also from the statement from Fed Chair Powell at the conference half an hour later, okay, which is going to be superbly crucial at how the market are they going to be apprehending his commentary, okay? So that is where the money is at, not at the actual decision in and of itself, again, because it was mostly priced in. So therefore, the markets are looking for additional clues. And from my point of view, the clues are going to be given, the clearest clues are going to be given from the renewed dot plot, which comes out 4 times a year. So this is going to give us a look on where the members are plotting the dots at. Where do they see interest rates moving towards to in the near future? And that's what the markets are bracing for, because they're going to start front running and look ahead on what the market and what the Fed is telling them they will do, okay? And assess accordingly the situation.
And also half an hour later, we have the press conference, the FOMC press conference, where Jerome Powell is going to address it. And every single word actually creates volatility. So we're expecting to see a volatile event for more than an hour, maybe an hour and a half.
Yeah, so again, the markets are going to be placing a lot of attention on what he says. Primary consensus is that the Federal Reserve chair is going to be somewhat cautious, but he's going to probably lean towards in favor of additional rate cuts. So that's what the baseline expectation is. It remains to be seen whether he's going to be super hawkish on this. So, I mean, he's going to say, you know what, we're not going to do only 2 this year, we're going to do 3, or we're going to possibly do 4, or at least in 2026 and onwards. Okay, so it's going to be superbly important to see what he says.
Of course, everything is, if we keep everything else constant, we know that everything is actually evolving and changing over time. But why traders care? Well, the main thing is when they cut interest rates, the US dollar loses steam, correct? People tend to spend money more than saving, right? So it's a pressure on inflation, I would say. And also consumers tend to go more on risk-on assets, such as the stock market, emerging market currencies, as well as maybe the cryptos.
So yeah, the traditional reactions you can observe after rate cuts are primarily leaning towards the risk-taking aspect of things. Yes, as you mentioned, the devaluation of the dollar shall be expected, mainly because the inverse relationship is also true. So when central banks actually hike rates, they make their currencies much more valuable, if you will like. So the contrary is also true. So when they start cutting rates, the devaluation is the most widely expected kind of scenario. And the primary reason is due to the fact that you have highest interest rates when you start cutting rates, when you start reducing rates, that in a sense lowers the interest payable by those people in the economy that do have loans. Okay, so in a sense, they're going to have more money, quote unquote, in their pockets, mainly because their interest payments for their debt are going to be lower. So therefore, you assume that with that extra money, they're going to go ahead in the economy and start spending, investing, and all that kind of stuff. So therefore, at the end of the day, you would expect to get higher growth expectations for that nation when the central bank of that nation starts lowering interest rates, because it's going to start promoting, in a sense, the spending activity within the economy. Therefore, you're going to get stronger GDP kind of prints in the future. And hence, if you get those kind of expectations for higher GDP readings, most likely you're going to get, at least in theory, higher return from companies in those economies. And therefore, that's why there is high demand around periods where central banks lower rates. So how much further can equity markets run? That is the question.
We'll see how inflation would react as well.
Okay. Again, another thing that we forgot to mention is that, yes, by lowering of rates, more spending comes live, if you would like.
There is higher pressure on inflation.
Yeah. The odds for reignition of inflation are also on the table. And if you add into the mix the fact that we have tariffs that were predicted to become somewhat reignitionary in nature, maybe that's going to be the concoction that is going to create a rise of inflation that's going to put the Federal Reserve in dire straits in a few months' time. Who knows? We'll see.
And we also see a lot of investors actually try to invest more on gold as to hedge against inflation.
Okay, safe haven play.
So safe haven. But gold rises not only because of that, but also because of the geopolitics and everything we see happening those times. But at the same time, this week is a heavily interest rate week globally. So it's not only in the US.
Last week we had the ECB deciding on their respective policy decision.
European Central Bank,
exactly. This week we have the Federal Reserve, obviously the main event of the week in regards to being the heavyweight of the central banks around the globe. We also have the Bank of England convening for their respective rate decision. We also have the Bank of Japan, and lastly, Bank of Canada. So yeah, we have a lot of policy decisions this week, and the FX market is going to be I don't know, it's going to be on fire, but yeah, we do expect to see some sort of sharp, volatile moves arising from hopefully not any surprises in regards to policy decisions.
So let's see how the Fed will act this week, all right? And this is our first podcast, as we mentioned. Of course, stay tuned for even more coming up.
Yeah. We're going to give you brief updates on what's going on with the wider global international scene in regards to finance and economics. Please follow, like, and subscribe for future updates.
And stay tuned, and always trade with confidence and proper risk management. Thank you very much.